Welcome back, my dear students. Welcome back, everyone. Another lecture in the accounting, and a new lecture in the accounting. And this lecture, we will talk about the some of the main important points which we usually handle on the accounting. Like as example now, let us see this entry. The company needs additional finance. So if I will increase the capital, I will do everything exactly like what I did in the start of the business itself. So it's from cash to capital. Before I talk, if we need additional investment and we will have more cash from cash into capital, same likewise what we did before in the starting of a business. So additional or extra investment in the business is dealt with as starting the business exactly. So we need more cash. So we will ask for the shareholders for more investments, and we'll say from cash into capital. The company needs additional financing, so officials goes to current potential shareholders and convince them to contribute cash. So the shareholders here will pay cash 19,000 in exchange of the new shares of the capital of the stock. So from cash into capital, 19,000. So we deal with the extra investments or expansion, same exactly like what we did in the start of the business, from cash into capital, same thing. The second thing, a sale was made. An account receivable was established that time for $5,000. Assume that the customer now pays the amount to the company, record the transaction. So once now we had already the payments, the one who took from us our goods or whatever we are paying, whatever we are producing, he bought from us. Remember, it was from account receivable to cash. Now, after he sold, after he paid, it will be cash to account receivable. This is the only case that the account receivable will be in the credit. So it will be to credit, from cash to account receivable with $5,000. This is the only case, and say again, that the account receivable will be credit. I will do now two examples here in front of you, and I will make you will solve them, then we will solve them together. On March 15/22, the company needs more cash for investments. Invested 10,000 in cash. So here, this transaction, we need money for expansion. So it will be from the cash into capital, exactly the same. So on March 15/22, the company needs more cash for investment. Invested means that they have already got the money and deposited in the cash box in the company, or the safe box in the company. So this will be like that way, like I will show right now. I would say insert table 4x4, and here we go. Here it is. Then here it is as well. So I will say here from cash to capital. Then this is 10,000. This is 10,000. And here this 10,000 will be down from cash to capital, and it's March 2015, 22. Control and C, March 15, 22. And we'll now write the, make it, this is 30, we'll make it like this way. Then expansion or more investments in business. More investments in business. This is the declaration or the discussion or the brief of why this transaction. So that's what you didn't, this is not a new thing. We just mentioned this already when we did the starting on the start of the business. It was also from cash to capital on the start of the business. So cash and expansion will be in the figure of capital, like you see here in front of you, will be in the figure of investments. So from cash into capital, exactly like what we did when we started the project. Okay. So the second one now, I would say now here, let me remind you, we have on March 16, the company sold goods to source goods of dollars 5,000, and payment will be due on March 30th. So on March 16, we sold goods of $5,000, and those $5,000 will be due on March 30. So this is from account receivables to sales. This will be from account receivables to sales. So we are selling here on credit. We didn't take any money yet. This is 5,000, and that will be March 16. March 16, from accounting receivables into sales. Perfect. That is very perfect. From account receivables into sales. But look at this now. Look at this now. The account receivable is here because we didn't receive cash. Because if it was cash sales, it will be from cash to sales. So here, sales on credit. Sales on credit means with payment, with later payment. On credit means with later payment. And here, okay. This is the transaction, and the 5,000 is here. We'll put it down here in front of the sales. And let me put this down here just once, because some students might be confused with the declaration. Okay, let us say now that these guys on March 30, on March 30, we received, we means our company, or the company received, so that someone will be confused about we, the company received the cash for sales was made on March 16. So here on March 16, we sold for $5,000, like what you see here, but we didn't take money. For that reason, we said from the account receivable to the sales. That's what happened. We said from account receivable to the sales. So let me take it here. Yeah. So that is on March 16, we did a transaction like this from account receivables into the sales. Really? Because what? Because we don't have already in that time, we did not have cash. For that reason, we say from account receivable into the sales. Perfect. Cool. But on March 30, this company which we sold to them goods for 5,000, they paid the amount due. They paid the amount due. For that reason, what happened in this transaction is that the cash is increased with this amount because we have cash. So cash will be debit. And the account receivable, which you see here in front of you, it was debit. Now to cancel it, it will be credit, ACC, account REC. That will be, and this is like I told you, the only case that we put the account receivable into be credit. Always the account receivable is debit, but this is the only case. Okay, cashing, cash, old sales, cash old sales. So, or cash the sales due on 16 or cash due on 30. Cash sales for cash sales for December 16 transaction. Cash sales for December 16 transactions. So from cash into account receivable. So the cash, because we received $5,000, that's the cash. And the account receivable here, it seems to us like because account receivable was debit. So you want to say that their balance will be zero. So the debit, you will put it as credit. So it will be from 5,000 the cash into 5,000 the account receivable. Or 5,000, sorry about that, 5,000. That's how it works. So here now, I will give you 3 transactions, and I want you to do like them exactly. Here we'll do everyone here. We'll start from a new page. Control and V here. This is the first transaction. We'll see what you will do in this. And the second, but I will change on March 17. The company needs more cash for investment, invested 20,000 in cash. Just I'm doing the exercise for you guys. This is exercise for you guys. Exercise for you guys. Here we go. So this is the first thing on March 17. The company needs, or we can say directly, the company invested or expanded, invested extra 20,000. The company invested, we can say like this. The company invested extra on March 17, 22. The company invested extra 20,000 in cash. So this is kind of expansion. So here you will do for me this one. On March 19, the company sold goods of LE 10,000, and payment will be done on March 31. On March 31, the company received the cash for sales was made on March 16, or sales was due on March 16. Actually, I'll put this in a small handwritten so you guys can see it. All the three transactions can be here. Here we go. Here we go. And I will please just give you about 5 minutes to do these transactions before we move into the next part of our work on this, on the journal entries. On the journal entries before we go to the next part. I'll give you around about 2 or 3 minutes here or 5 minutes to do the three transactions. This is the first one. The three transactions, please do them. The three entries. On March 17, 22, the company invested extras 20,000 in cash. On March 19, the company sold goods of LE 10,000, and payment will be due on March 31. On March 31, the company received the cash for sales was made on March, on March 19. I didn't fix this one on March 19. So let us do these three transactions, please. Finish all of them. Then we will move forward to something else. We'll have around 5 minutes to finish this purpose. Thank you so much. Okay, I think the time came now for us to work on these questions again. To do these questions, and I will do them one by one also. Here, I will do them one by one. So on the first one here, let's insert a table. Here the table is, and we'll do the first one here. Of course, I can put all of them in one account, and I can do this as well also, so that will be appear in front of you. That's fine. I can do the three here, right? And I will take them up like this way. Okay, here I will do the graph for all of them, insert table, and here is 4 by 3 because we need only this. And here we go. This will be our first line, and this will be, we need more we don't need all these columns. We need 1, 2, 3, 4 columns, but we have one more column more. That's okay. That's okay. Let us remove this, delete cells, delete entire column. Here we go. So here now we have our transactions will be done here in this part. Here we go. So this is for the debit. This is the date. This is the description. This is date. You can say like this. This is description, DES. And here we go into debit, DEBIT. And here we go to the credits. If you want to write them like this, you're fine. Then on the date March 17, here is March 17, Control and C, March 17. The company invested extra money, so this is from cash into capital, cash, then to capital, extra, this is the extra investments, extra investments. So here we'll say from cash to capital, and this is cash to capital. And the words extra investments here is declaration for the type of the transaction. Here we go. Now just leave part for it here. And the extra for 20,000, this is the amount 20,000. Here we go for the amount 20,000, Control and C for the amount 20,000, here and V. And this is also here. And we'll go down here for the, so it will be, this is the first transaction on March 17. Second one on March 19. So the second one is in March 19. On March 19, here we go, Control and C, and go for March 19, Control and V. And what happened on March 19? The company sold. So this will be from account receivables into sales. Like we said before, receivables into sales because we didn't have in cash. Like you see, sold goods of LE 10,000, payment will be due. That means we didn't receive cash. The word payment will be due on, that means they didn't pay for us. They told us we'll pay later on. So once we see this word, payment will be due, or you felt from the sentence that the company did not receive cash, because if it's received cash, it will be very explicit. We'll tell you it received cash. So that means from account receivable into sales, account receivable. And I told you before, you can write account receivable, S-C-O-U-N-T, receivable, R-E-C-E-I-V-A-B-L-E, or you can write S-C-R-E-C, means account receivable into sales. And that was for the amount of the 10,000, 10,000, Control and C. Here, Control and V. Then here, Control and V again. And this amount, I will put it down. Then I will take this down like this and say down in the description here, sales on credit, sales on credit. Cool. That's the second one. Third one, on March 31. So here we will go to March 31. Here is Control and C. And we'll add more now, unit, March 31, Control and V. What happened on March 31? The company received the cash. So what happened in the previous, this transaction, now it was on credit. So now the people will pay. On March 31, the people will pay this $10,000. They will pay this $10,000. So here, what happened? Actually, when we receive the cash, because we will receive cash, the 10,000, we receive the cash. So the cash is a debit. Increase in assets, increase in an asset will make it debit. So cash will be debit here into what? Into account receivable. Why? So this is the only case, like I said, the account receivable will be credit. Why? We are canceling the transaction now because they were here. They had to pay, and here they already paid. So once it was debit, we will make it credit so that this and this, then the balance will be zero because they paid all their balance. They paid all their balance. Control and C. Here we go, Control and V. Here we go, Control and V. Then we'll take here this down. Then settlement of payment due. Settlement of payment due, because in that day there was settlement of payment due for this amount. So today we know if we want to expand the business, same like starting the business from cash to capital. Any expansion, any more investments, it will go from cash into capital, because we'll take the capital from the shareholders and we'll add it. We'll take as example 10,000, 15,000, 20,000. We'll add it to the cash in our books or in our safe. So the cash will increase. The cash will be debit, so it will be from, and the capital will be credit, like what you see here. That's the first point. Secondly, we sold on credit. By other meaning, we sold, but we didn't receive the money yet. So it will be from account receivable into sales. From account receivables into sales. And this we say sales on credit, or sales and payment later. Our sales and payment later. The third transaction, March 31. That is, those people which we bought from on March 19, they bought from us on March 19. Now they will settle the amount due. They will pay for us this amount. So in that case, we would say from cash into account receivable with the amount which is $10,000. Settlement of payment due. And that was the last one. Till the moment, my dears, I'm done for today. And I want you to do this again and again and again by your hand. I just want you to do this again and again and again by your hand. And particularly when you see here, you can see the 3 transactions, and here the 3 inputs in the journal entries, and all of them together. So it will be in front of you and you can see it. You can stop the video whenever you want and look to them again. Remember that when we do investments in the future, extra investments for expansion, we behave same way and the same entry, journal entry, which we did in the start itself, which we did in the start when we started the business from cash into capital. But instead of starting business, extra investments in business. That will be the data or the description of the transaction. March 19, we said after this, if we sold on credit, by other meaning, we sold goods, but we didn't have cash in our hands, then this would be from account receivables into sales. We really sales, so sales from account receivables to sales. Once this settlement is done and we received our money, so the money will increase in our books. So it will be, the cash will increase, it will be debit from cash 10,000 into account receivable for the 10,000. Settlement of payment due, and this is the description of the entry. Till the moment I'm done, shall see you in the next video. Take care of yourself. Have a very wonderful day.